Hey, it's Lewis here and welcome back to the channel, and in today's video we're going to be analysing Lockheed Martin stock. We'll be using TIKR terminal to go through the financials, and then I'll set the cash flows into DCF and we'll come to a fair value of their stock. Let's get straight into it. So who are Lockheed Martin? So Lockheed Martin Corporation is an American aerospace, arms, defence, information security and technology corporation with a worldwide interest. That was a mouthful, wasn't it? So it was formed in the 90s after a merger of the Lockheed Corporation and Martin Marietta in 1995. It's headquartered in Washington DC area as well. Very big company. It's one of the largest companies in aerospace. I think it's the biggest aerospace company in the world. Biggest defence company in the world anyway. And yeah, the US federal government contractors, Lockheed Martin topped the list of US federal government contractors, and it basically received 10% of the funds from the Pentagon, so it's a really big deal in terms of US security, etc. The company itself is involved in all sorts of stuff, including the F-35 fighter jets, probably the most famous thing they're known for. The company itself is listed on the New York Stock Exchange. It's a component of the S&P 500 index. Now let's have a look at the sales for Lockheed Martin, and we'll look at the sales for business to start with. So look at 2021 sales. So aeronautics make up 40% of sales, rotary and mission systems make 25%, space makes up 18% rounded, then missiles and fire control make up 17%. And sales per region, where the sales around the world, so United States makes up 73% of sales, so predominantly the US government, Europe 10%, Asia Pacific 9%, Middle East 6%, over 2%. So predominantly a US company, US sales linked to US government contracts. Now let's have a look at the financials for Lockheed Martin via TIKR terminal. We'll start with the income statement as always. We'll do 5 years to make things simple. Over the past 5 years, revenues have increased by a fairly decent amount, from about $50 billion to, 67. So, decent increase, steady increase. Yeah, happy days. We will take it. Net income, net income has increased as well. I'd say, from 2018 to 21, it's relatively flat, so not much really going on. So we want to be paying a lower multiple for this business if the profits aren't growing that quick. Something to bear in mind. Weighted average diluted shares, so the share count is going down slightly. This is a good thing if the company is undervalued. We will come to see if that's the case. But yeah, shares have been decreasing ever so slightly. Let's have a look at the balance sheet, and cash on hand has been going up. But then the last 12 months it's down to 2017, so don't know what's going on there. But let's have a look at the debt. So debt over the past 5 years has decreased slightly, but it's pretty much at the same level, let's be honest. But it's decreased by a little bit, I guess, not by much. Retained earnings have gone up a bit, so they've been making consistent profits. Love to see it. Total debt has gone down, you can't knock them for that. Cash flow statement, so cash flow from operations and capital expenditure, these two figures combined make up free cash flow. So let's do just a brief overview. 2017 compared to 21, yes, free cash flow has increased over the past 5 years. Awesome. Let's have a look. So been like we've seen, we've been repaying debt, buying back shares, and dividends. Here's a big one here. We've been increasing the dividend year on year, so that is really good stuff. Love to see that. Onto the ratios now. Here we go. So return on capital, very solid. I really like to see this in the 40s, 30, 33 and 21, but very high return on capital for this business. Love to see it. The margins are very high for this business, but I guess it doesn't matter. If the returns on capital are high, it doesn't really matter what the margins are, to be honest. But I do like to see high margins. It's a sign of a good quality business usually. But it's not too bad, I'm guessing. Yeah, it's not that bad really, is it? So the CCC isn't above 60, but we can deal with it. Current ratio is above 1. Love that. Dividend yield, just something to note, 2.5%. Not horrific, to be honest. Total debt to capital is a little bit high, I'd say, at the 55% mark, but if we can decrease this, by either growing or repaying back debt, I'll be happy. And yeah, so that's all the ratios, that's all the financials from TIKR Terminal. And if you'd like to use TIKR Terminal, I've got my affiliate link below. Please click on it, sign up to TIKR Terminal, have fun analysing some companies. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions, you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger, and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you there. Now let's have a look at the genuine impact stats for Lockheed Martin, and we'll start with the quality metrics. So it's currently ranking high for quality, which is really good. So profitability high, financial strength weak, capital allocation very sound. So overall it's looking decent. Financial strength there, I'm not quite sure, maybe something to do with the debt, potentially. Value-wise, it's looking expensive though on all metrics. Income statement and cash flow medium, and balance sheet very expensive. So it's looking, it's just looking a bit expensive to be honest. Historical growth medium. So dividends per share very high. So we've been buying back shares, increasing the dividend. Double whammy. It means the dividends per share are going up, which is a good sign for us investors. But then medium growth, which is for a company of its size, it's not too bad really. Some interesting insights there from genuine impact. Now let's have a look at my analysis checklist for Lockheed Martin, and market cap 115 billion, current price is $434. Not a lot that really matters at the minute. PE ratio of 19, earnings yield of 5%. So the first pillar, profitable, high returns on capital using low leverage. These three things combined, in my opinion, show signs of a high quality business based on the financials anyway. Return on capital for this business is very high, 43% 5-year average. Can't knock them all. Profit margins and free cash flow margins are not above where I'd like them to be, 40%, 10%, 10%. But because they're consistent, I can't really knock them, but I've got to have some set criteria, but unfortunately it does miss them out there. Current ratio 1.4, we will take it. CCC is not above 60, we'll take it on the chin, but we do like to see it below 60 because we want the company to bring its cash in very quick. That's a very good sign. Total debt to capital, 55%. Want this to be lowered. Hopefully we can do this via inflation eroding it, via even paying it back, or growing out of it. Whatever it is, we want this to be going down. Proven ability to grow, all green across the board, lovely stuff. Not much to comment apart from great news. Great capital allocation, we've repaid long-term debt, bought back shares, grown the dividend, and good acquisitions. Basically, we haven't had any bad acquisitions because we haven't written any assets off, so that's a good sign. Overall, the quality score is showing 67%, mainly because of these red up here. If these three were green, it would be a lot higher, but it is what it is. Buy at a fair price. Currently, both of these are green. Price of free cash flow is 15 and PE ratio is 19. This price of free cash flow is, not too bad really. I like to see it closer to 10 if I'm getting a good deal, but I think it's reflective of what my DCF is showing as well. So current share price is 434, 327 is what it needs to be, so it needs to drop 25% for me to be interested. It just needs to drop 25%, simple as that. Let's have a look at the DCF now, and so predicting 3 years worth of free cash flow into the future via marketscreener.com. Not very high growth. Looking here, top of my head, it's single digit growth, very low growth. Conservative, it's a big business. I don't see it growing at double digits, and if you do, you're probably just kidding yourself, to be honest. You've got to be conservative with these companies. These are going to grow at single digits, but they're good quality. So what's that share price? 327. So for 10% return, $327 per share. Just needs to drop a bit. So let's have a look at the stock price and see over the past year. Has it been at 327, sorry. Just just at the end of 2021, it was nearly there. What about COVID? What did it get to? So yeah, in 2020 it did get there, so there's no reason why it couldn't. But yeah, like I said, I'm not interested in this company until it hits 327, and then I want a bit of a margin of safety on there. So simple as that. Good company, you know, solid financials. It's not going to go anywhere with the US spending as much on defence as it does, but it just needs to drop 25%. Simple as that. So there we have it. That was my full stock analysis for Lockheed Martin. If you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time.
Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.